Hi, my name's Steve Clapham and welcome to another in our Valuation 101 series. And what we're going to look at today is the first in our EV multiples videos, looking at EV/EBITDA. EV/EBITDA obviously is one of the most popular valuation tools, so let's look at it in some detail. I've said before in some of these videos, if you've watched any of them, and please do watch them, do subscribe to the channel, you can't use market cap measures in isolation for companies. Using an EV-based measure removes the distortion of debt, which can be used to juice EPS and juice returns to equity. Always check at least one EV measure, and the measure that most people use is EV to EBITDA. It's pretty popular, it's very simple, it's in some ways easier than price to cash flow, although actually, interestingly, it performs less well if you do value back tests. And it doesn't give you as accurate a picture of the true cash generation because obviously it doesn't include working capital. And if you look at what Moody says about EBITDA, Moody's got a lot of criticism of EBITDA and the general application of EV/EBITDA. First, there's this one element that I was just talking about, where price operating cash flow is better because EBITDA ignores changes in working capital and can therefore overstate the cash generation. It's not a measure of liquidity. It ignores required reinvestment, especially if you've got companies with short-lived assets. So EV to EBIT is a more useful measure. And I'll talk more about that in another video. Obviously, EBITDA doesn't tell you anything about the quality of earnings. And it's not a great standalone measure for comparing acquisition multiples. And obviously, it ignores the quality of the cash flow arising from different accounting policies. I'm slightly dubious about that point because, yes, if you're looking at the EBITDA measure, if a company is being particularly aggressive in the way it reports earnings, that EBITDA will be overstated. But if you're using it in conjunction with, say, a free cash flow measure, then you will get an understanding of the quality of the earnings because you're effectively looking at cash, not just earnings. The other point is that, not all revenues are cash. EBITDA isn't a common denominator for cross-border accounting conventions. This is the same point, really, about the quality of earnings. It uses, when used in indenture covenants, it offers a limited amount of protection, and it can drift from the realm of reality, especially, many companies are using adjusted EBITDA measures, which leave out a whole raft of charges, which are very, very relevant. And, there's some industries where they've got funny attributes where EBITDA isn't as well suited. But my favorite criticism is from Jim Grant, the Grant's Interest Rate Observer. And he was particularly critical of Valiant. And you'll all, I'm sure, watching this video, you'll all be familiar with the story of Valiant, where it was exposed as being fraudulent in its accounting, and the stock lost $80 billion in a matter of weeks. And what Jim Grant describes Valiant's EBITDA is EBITDA H, earnings before interest, taxes, depreciation, amortization, and a hunch, which I thought was a great description. You need to be slightly careful because low margin industries can often appear cheaper on EV/EBITDA because they've got a lower multiple. But remember that depreciation can be a more significant component because these businesses often have a higher capital intensity. And that's why EV to EBIT is a more useful tool than EV/EBITDA. In the next video, I'll show you some other EV multiples which you can also use in conjunction with EV/EBITDA and then in conjunction with conventional stock market multiples. Thanks for watching. Don't forget to subscribe to the channel.